Well, this morning's inflation reading came in softer than expected, up just 0.1% from the previous month. We did see stocks pop on the release. Well, now it's over to the Fed, which looks to set to hike rates again tomorrow, with a downshift of 50 basis points, widely expected. Approaching a new year with recession bets rising isn't what anyone wants, but the Fed and Wall Street do seem to be on different pages as to how 2023 is likely to play out. Morningstar's weighed into the debate with its outlook. It sees the possibility for stagflation and says the emphasis for portfolios should be planning over prediction. We are joined by Marta Norton, Chief Investment Officer for the Americas at Morningstar. Marta, good to talk to you today. Let me just first get your reaction to what we saw in the market today. We saw that CPI print come down, Dow futures popping on that. Are we back to kind of getting ahead of ourselves before we hear from the Fed tomorrow?
I think that's always a risk, Akiko, and thanks so much for having me. I think that's always a risk when we have huge market reactions to a single data point. Now, I do think there's some sense to a celebratory dance. The Fed has said that it's watching inflation prints closely. It's looking for tangible signs that we're at an inflection point in this war against inflation. And when you add November's print on top of October's print, and you see some of this cooling or some of this kind of pullback from these peak levels of inflation, I think there's good reason for the market to say that, potentially we could see the Fed back away from some of the extreme moves it's made on the rate side this year. But I do think that we want to be careful about extrapolating too much from one or two data points.
And we know that's the same feeling that the Fed has. They clearly want to see more consistent data that inflation is cooling. But we did see the headline number, as you mentioned, there, 7.1% for headline inflation, 6% for core inflation, and that's versus the 6.1% that was expected as well. For people who are trying to sort of plan for what to do with their portfolios, then what should they be looking at right now?
Well, I think there's two major questions, Rochelle, that the market still needs to grapple with. One relates to the labor market and seeing some cooling there, which hasn't really taken shape the same way that we've seen some pullback on inflation prints. And then I think the other thing that the market needs to grapple with, investors need to grapple with, relates to the impact of these Fed moves on the overall economy and what that means for a recession. So from our perspective, from the perspective at Morningstar, the range of outcomes remains fairly wide, and where we see inflation level off in the long run, what we see happen on the economic side in terms of a recession, those are sources of volatility for the market, and we don't necessarily have answers for those. So when we talk about planning over prediction, what we're really thinking about when it comes to portfolio construction is creating a range of different asset classes that can respond differently to different outcomes. So imagine an environment where inflation remains sticky. Tips in some areas of energy might, continue to make sense in a portfolio. At the same time, if you start to see disinflation and a cooling as we're seeing in inflation, we could start to look at some areas, in the value spectrum of equities or within fixed income that could do reasonably well in those environments. So it really makes sense in our view to have this kind of spectrum of asset classes that can do well in a range of different environments.
How do investors determine just what kind of exposure to have? I mean, you just put it up 4 big scenarios. It could really go in any direction.
That's right. So uncertainty remains very high. So I think that the real wisdom here is not to plan for one particular environment. It would be really tempting if you start to see the market recover, you start to see these inflation prints start to cool off a bit, to really go hard into risk assets. So loading up on all types of risk, whether that's high yield bonds or whether that's equities across the risk spectrum. And our perspective is that it makes sense to take some caution and to move a little bit more slowly than you otherwise would, and not say that this is an all-in, putting all chips into the center of the table type of environment, but rather thinking about how is this asset going to do relative to that asset. And that's where the real nuance of portfolio construction comes into play.
And Marta, just quickly, in terms of some of the geopolitical, some of the international impacts that might be having on U.S. portfolios, anything that people should be keeping an eye on or that might be under the radar right now?
Right. I wish I could say that question around international is an easy one to answer, but we also see some kind of mixed signals overseas as well. So valuations, the price that you're paying for the assets that you're getting, they look pretty attractive, whether you're looking at non-U.S. currencies or whether you're looking at the actual local assets. And so I look at areas like China, I look at areas like the UK, like Germany, European financials broadly. All of those areas look pretty attractive to us when we take into account both the currency and the local assets. But as you note, there is some uncertainty over there when we're talking about the geopolitical tension, when we're looking at things like how the European energy crisis could play out, when we're thinking about some of the troubles that the UK has had. And so from our perspective, it makes sense to start to be overweight some of these areas. But again, to do so with a bit of caution or with a bit of kind of a steady hand. So not going kind of to a full overweight, but having some exposure because the valuation suggests that we should.
A cautious balance everyone should take then. Morningstar's Marta Norton, thank you so much for joining us this morning.